everybody. Welcome to today's fundamentals. Hello, Peter. What's new in the FX market?
Well, we had a US dollar which remained rather stable in sideways motion, I would say. Overall, it seems like the market has a wait-and-see position. There was the release of Eurozone's final HIC period for March. It remained unchanged if compared to the preliminary release, practically reaffirming the slowdown for the month. Other than that, I would be noting that we had Canada's house starts. They were from March. They dropped. Overall, that tended to signal once again bad days for the Canadian construction sector, which may overall highlight a real estate issue, which is not only in Canada actually. We have similar issues also in the US, even wider. And I think the main release of the day was from New Zealand. It was the CPI rate. It was for Q1 and it slowed down more than expected, reaching 6.7% year on year. The release as such, I would say, may ease the aggressiveness, the aggressive hawkish stance of RPNZ. And that could cause the Kiwi to slip. Also, during yesterday's Asian session, I would note Japan's improved trading data. And on a more monetary policy level, I would note the heat which RBA is getting about how it functions and its mission. And that's coming from Australian lawmakers, may have an impact on the Aussie in the long term.
And how about US stock markets?
Actually, US stock markets were quite interesting. We had, US stock markets in general sent out mixed results. I would be highlighting though that we had a number of earnings releases which were quite interesting. Say we make a start with Tesla. Now Tesla's share price opened yesterday with a negative gap. And that came after the company practically announced another price cut on its models. And there was a slight correction higher during the normal trading hours, and after the closure of the US stock markets, we had the release of Tesla's earnings reports, and it missed both the earnings per share figure as well as the revenue figure. It came out lower. And I think that could add additional downward pressure on Tesla's share price today. Other than that, I would also note we had Alcoa. Alcoa also missed its target both on an EPS level as well as on a revenue level. The aluminum processor practically seems to be spelling trouble here. And I would also be adding here my worries about the mining company Rio Tinto and the resource company, the Australian resource company BHP Group. So it's a slight chain here for the whole sector, which is a little bit worrying. We had also mixed signals from IBM, the high tech. By the way, TSM is to release its earnings report today. And I would be noting on a more positive note that we had good, solid earnings releases from Morgan Stanley, which more or less tended to solidify the market's view that the banking sector seems to remain strong and sound. And that was also providing a more fundamental reassurance that the banking sector was able to overcome the debacle of SVB and Signature Bank. Overall, I would expect market to move according to earnings releases which are coming out today and tomorrow. But I would also highlight the possibility that we may see a market reaction should Fed policymakers today actually sound a little bit more hawkish. That may cause US stock markets to drop a bit.
And how about gold?
Gold's price actually yesterday initially dropped and dropped substantially, but over the course of the day it corrected a little bit higher. Nevertheless, ended the day in the reds. I would note that we may see the negative correlation between the US dollar and gold remaining on stage. We may see gold's price getting a slight boost should US yields correct lower or continue to correct lower, given that bonds are informally competitor in the safe haven market for gold, and a drop of US yields would practically make gold more attractive. It's characteristic, in my opinion, that gold maintains a sideways motion just below the psychological threshold of 2000. Should that be broken, then we may see it start aiming for an all-time high at 2075.
Mm-hmm. And what's new regarding oil?
Oil is dropping for a fourth consecutive day.
Mm-hmm.
At least it was during today's late Asian, early European session. And it's dropping despite the EIA reading yesterday showing a substantial drawdown of over 4 million barrels. That tended to imply that the US oil market remained tight, but it had little, if any, effect on oil prices. I expect that despite some analysts mentioning that a strengthening dollar is weakening oil prices, I'm saying that the US dollar has not strengthened to that extent to affect oil prices just yet. I would be focusing more on demand issues, and we see slowing manufacturing activity both in China as well as in the US, which could have an adverse effect on oil's prices. I would be also noting, though, that Russia has increased its output and exports of oil, meaning that we have a higher supply side as well. So practically oil prices are being hit on both fronts, both on the demand side as well as on the supply side.
Mm-hmm. So what's on today's calendar?
Well, we have a number of releases. We had already France's Business Climate. I would be highlighting actually today 4 releases. The first would be from the US initial jobless claims figure. It's a weekly figure. It's expected to tick up a bit and could weaken the US dollar. I would be noting definitely the Philly Fed Business Index for April.
Mm-hmm.
It's expected to rise, but it's still in the negatives. And that may mitigate any support for the USD.
Mm-hmm.
From the US, we also note the release of the existing home sales. They're expected to drop, and that's a general, or if you prefer, a sign of a general, I wouldn't say crisis, but definitely slowdown in the US real estate sector. And last but not least, we're getting from the Eurozone the preliminary consumer confidence. It's for April. It's expected to improve somewhat and could provide some support for the euro. We have lots and lots of commotion on the monetary front. We have ECB President Lagarde speaking. We have from Bank of England MPC member Tenreiro, which usually sounds a little bit more dovish. So should that be the case today again, we may see the pound slipping somewhat. From BOC we get Governor Tiff McClellan.
Mm-hmm.
And we have a wide range of Fed policymakers. I would be noting Cleveland Fed President Mester, and I would expect Mester to actually sound a little bit more hawkish, which may provide some support for the US dollar. During tomorrow's Asian session, we have a number of releases. I would make a start with Australia's preliminary manufacturing PMI figure for April. Also note Japan's preliminary manufacturing PMI figure for April. The highlight, though, in my opinion, would be Japan's CPI rates. The rates are expected to remain unchanged or slow down. Should either of that be the case, we may see JPY slipping a little bit, as that would imply an easing of inflationary pressures, which may reduce the pressure on BOJ to actually tighten its monetary policy.
Mm-hmm. Great. Thank you, Peter, for your time. And everyone for watching. Join us after a short break for technical analysis with Peter Iosif.
Hello, my name is Peter Yosef, Senior Market Analyst at IronFX. In front of your screens, you have the US dollar index. It's the 4-hour chart. All charts to be presented are to be of the same time frame unless otherwise stated. Now, with no time to waste, we highlight the tight, very tight range-bound movement presented for the USD over the past 24 hours almost. So I would expect practically the index to remain in a sideways motion, given that it had already a sideways motion. This time just above the 101.55. Note that the RSI indicator below the 4-hour chart has flattened out and it's currently at 54, which is quite close to the reading of 50. It's as if the market maintained a wait-and-see position, and it's indicative of the low volatility, the fact that the Bollinger Bands have converged, thus allowing practically for the sideways motion to be maintained. Should the bulls take over, I would expect the price action to rise, break the 102.45 resistance line. I would require a higher peak than this one, and start aiming for the 103.45 level, which was tested here as well and here to the downside. On the flip side, should the bears take over, we may see the price action dropping, breaking the 101.55 and aim, if not reach, the 100.65 support line. Let's have a look at Euro USD. Similar movement, once again in a sideways motion with one twist. We also have an upward trend line which has been guiding the pair since the 20th of March. Yep, since the 20th of March. So it's in an upward trajectory, yet there is a very tight range bound movement, and it's characteristic how the pair stabilized over the past 24 hours even more. I would expect the sideways motion to be maintained, given that we have an RSI indicator which is practically running along the reading of 50, implying a rather indecisive market. On the other hand, we still have a clear-cut upward trend line. For the bullish outlook to be abandoned, I would require a breaking of the pre-mentioned upward trend. For the bullish outlook to be abandoned, I would require breaking of the upward trend line and the price action to remain just above the 1.0925. That would solidify our view for the sideways motion to be maintained. On the other hand, should the bulls finally take over once again, for a bullish outlook, I would require a higher peak than this one. In that case, that would mean practically that pair has to rise, break above the 1.1075, and start aiming for the 1.1220. On the flip side, should the bears take over, we may see the price action dropping, breaking the upward trend line mentioned, but also I would require clear breaking of the 1.0925 and the pair to start aiming for the 1.0760. Okay, let's have a look at GBP USD. Once again, clear-cut sideways motion, with the pair remaining comfortably between the 1.2540 resistance line and the 1.2350 support line. It's characteristic how practically the moving averages, the 20 moving average, which you can see in blue here, is the median of the Bollinger Bands. The 50 moving average, which is the green line, and the 100 moving average, which is the orange line, all of them have flattened out and practically would imply that the sideways motion is to be maintained. The same applies also for the Bollinger Bands, which have narrowed, exactly reflecting the low volatility, while the RSI indicator is running along the reading of 50, also implying a rather indecisive market, which may allow for the sideways motion to be maintained. So the base scenario remains, or at least all indications point towards a sideways movement to be continued. Should the bulls take over, we may see the price action rising, breaking the 1.2540 and start aiming for the 1.2770. On the other hand, though, note that there was a strong test on the R1, yet the level was able to hold its ground. While on the flip side, should the bears take over, we may see the price action dropping, breaking the 1.2350, which serves as a lower boundary of the current sideways motion, as it was tested here, and also to the upside here. And a possible break of the S1, a decisive break, would open the gates for the 1.2185 support level, which was tested once here, twice here, and to the upside here. So it's a pretty valid level as well. Let's draw the current sideways motion. Here you go. It's a very, very characteristic sideways motion here. On the other hand, you know what? I would like to have a second look at where the R2 1.2770 is resting upon. Quite certain that it's valid, but let's have a recheck. We haven't visited that level for a long time. Okay, the R1. The R2 rests here practically. Okay, that was a peak of a day. Let's drill to the 1-day chart. Yeah, sideways motion is being maintained. But note that the R1 has not been broken since early June 2022. Okay, we're talking about 10 months here. That's interesting. That may bring some difficulty for the bulls here. Let's move back to the 4-hour chart. Readjust it. And switch now to safe haven currency pair USD/JPY. We have a different picture here. There were some slight worries in today's European session that the pair may initiate a downward motion. That becomes more clear if we drill to the 1-hour chart. Note how it's testing currently the upward trend line. Now, should that be clearly broken, not just shifted a little bit to the right, that would be signaling a change of trend from an upward movement, which would be interrupted, to practically a sideways motion between the 135.70 and the 133.70. But I would like to see a clear-cut break of the upward trend line before deciding anything here. Why? Because I highlight that we have the 20, the 50, and the 100 moving averages all pointing upwards. It's interesting also to note that the pair was able to mark continuous higher troughs and higher peaks. Now, should the bulls regain control, once again, I would expect it to break above the 135.70. Sorry, a level which used to be a prior support line. You can see it providing support here. Yet has now turned to a resistance line given that the price action has moved it below it. The R2 137.80 rests practically on this peak here. On the other hand, should the bears take over, we may see the price action dropping, breaking the 133.70 clearly, and start aiming for the 130.40. Mind you that the levels were the prior upper and lower levels of the sideways motion of the pair and were tested extensively. So they're pretty valid. Okay, let's have a look at USD CHF. Clear-cut sideways motion. It's interesting though how the Bollinger Bands have converged, reflecting the low volatility. The RSI indicator, which continues to run, run along the reading of 50, implying once again a rather indecisive market. On the other hand, we have a long-term downward trend line, which may be of interest. What I'm talking about is that practically the boys at research have mentioned this. Which, on the one hand, it is an issue. You have consecutive lower peaks. You have some stabilization here, though, and lower truths, but not the correction. So, in a long-term view, if we drill out to the daily chart, that would be more visible. There are some bearish tendencies. That's clear. On the other hand, though, if we drill to the 1-hour chart, you see a stabilization of the pair, which is also visible in the 4-hour chart. For the time being, we tend to maintain a bias for the sideways motion to continue. And in that case, we may see the price action actually breaking the downward trend line pre-mentioned. By the way, let me clear this, get this out of the way, as well as this. But should the bears actually take over, we may see the price action dropping, breaking the 0.8935 support line, and I would expect it to drop as low as the 0.8860. It's a wide drop, and it may not be within 24 hours, but this level signifies practically a prior true. So I would like to see USD JPY breaking below it. Once again, though, the main element of switching our bias for sideways motion in favor of a bearish outlook would be initially the breaking of the S1 0.8935. It's the low boundary of the current sideways motion. On the other hand, should the bulls take over, we may see the price action of USD JPY being on the rise, breaking the downward trend line we have just mentioned. That would be another signal that the downward movement has been interrupted. However, this case for a bullish outlook, I would require also a clear break of the R1 0.9020 and the price action to start aiming for 0.9115. Moving now to AUD USD. Sideways motion being maintained between the 0.6755. Let me reposition the labels a little bit so we get a more clear picture here. There you go. It's a very indicative sideways motion with the RSI indicator just below the reading of 50. It's actually now at 45. Could go a little bit lower, but for the time being it holds. The RSI indicator have narrowed. The Bollinger Bands have narrowed, which also tends to reflect the low volatility present in AUD USD. Should the bulls take over, I would expect the pair to rise, break the 0.6750. A higher peak than this one would be required, so I would expect it to reach the R2 0.6855. In case of a bearish outlook, I would expect the pair to drop, break the 0.6625, which was marked here and here. And in that case, the gates would be paved, would be open practically for the 0.6520. Once again, for the time being, we tend to maintain our bias for a sideways motion to continue. Now let's have a look at commodity currency pair USD CAD. Now that's a different picture. We have a nice upward motion, which seems to be maintained. It's small but steady and seems to be pointing upwards towards the 1.3545. Note also the RSI indicator, which is at the reading of 70, underscoring the bullish sentiment of the market. Should the bulls maintain control, I would expect it to rise and reach the 1.3545, if not even break it. On the other hand, we have to note that a correction lower is possible, but for the bullish outlook to be maintained, I would require the price action to drop, yes, correct lower, yes, but remain above the upward trend line we have drawn. Should the upward trend line be broken and the price action approaches but respects this 1.34 and remains above it, then we may be talking about a sideways motion. On the other hand, should the pair drop, break the 1.34 and starts aiming for the 1.3270, that may imply a complete reversal and practically the adoption of a bearish outlook may be advisable. Maybe. It's not certain. Okay, let's have a look at the Kiwi. The Kiwi, which it's interesting to see whether there was a market reaction at the release of New Zealand CPI rates today, which were far lower than expected. In the minute chart, nope, nothing much here. Let's go further back. Whoa, that was it. Here you have it. Note the steep drop exactly witnessing the slowdown of the New Zealand CPI rate. We're talking about a drop of around 30 pips, 31, within the first 2 minutes of the release. That was impressive. Note how the pair even corrected lower later on and remained at lower levels. Had to correct practically as the Asian session was about to end and the Europeans started taking over, but it still is at lower levels than what it was before. Note it was upward here and currently it's here. So practically the losses made were sustainable for USDJPY. Sorry, for NZD USD. The RSI indicator is low, but it's actually at 39, which may be indicative of some slight bearish tendencies here. After the pair's drop, it stabilized. It's characteristic that it hit the low bulge band before stabilizing. Okay, we may be drawing a downward trend line here, but we have only one peak verifying it. So I wouldn't exactly trust it just yet. But should the bulls maintain control, we may see the pair dropping once again towards the 0.6090 support line. On the other hand, should the pair stabilize or remain stable, we may see it breaking the downward trend line we have mentioned and remaining just below or move around the 0.6190 now resistance line. For a bullish outlook, I would require a decisive break of the mentioned downward trend line, a decisive break of the R1 0.6190, and the pair to start aiming for the 0.6270. Now, given that there's little coming now from New Zealand, I would expect the pair to remain mostly USD driven. So should the US dollar weaken substantially, we may see that allowing for the pair to stabilize at higher levels or even start rising. Let's have a look at gold. We haven't checked that since yesterday. It was just a quick glance. Okay, we were hunting for a new upward trend line. Sorry, for a new resistance level. And there is none. The R2 is the all-time high. Readjusting the chart. Okay, let's verify the levels once again. The R1, which is being set at 2031. The R2, which is being placed at, let's have a look, 2070, okay. And the R3 at 2100. Could actually go higher, but as a psychological factor, I'm setting the 2100. The 1985 as the first support line. Yeah, that's in the clear. 1935 as the second support line. 1890 as the third support line. Okay. So a sideways motion could be maintained here. I'm keeping this one and consider this as a false break. It's characteristic how the precious metals price dropped yet quickly jumped back up again at the same levels it was. Sideways motion seems to be maintained. There is our indicator. It's just below the reading of 50. It's actually at 46. Also rather implying a rather sideways motion between the R1 2031 and the S1 1985. Should the bulls take over, I would expect the price action to rise from the 1996. By the way, let's put also one small level to mark where the 2000 level is. Very close. So in case the bulls take over, we may see the price action definitely breaking above the 2000 level and aiming, if not breaching, the 2031. While should the bears take over, and that should not be surprising the markets, we had a drop yesterday which was substantial, then we may see the price action of gold dropping, breaking the 1985 support line and start aiming for the 1935. Let's have a look at Dow Jones. Okay, let's reposition a little bit the labels. It's a very interesting sideways motion. However, I would like to recalibrate practically the resistance lines. Definitely this peak here tells us there's a new high here. So let's lower it. $34,160. And I would like also to reposition the R2. Let's go further back. This is an interesting peak. Okay, the R1 has another verification here. So the decision to move it was correct. And there's also verification of the R2. Somewhere here. At the 34,920. Let's have a look at the R3 as well, since we added. Let's lower it to this peak here. 35,510. Further back here. We have verifications here. Good. Let's keep it. Readjusting the chart. The R2 now, which is being placed at 34,920. And the R3 far, far lower at 35,510. Now, the guys at research also recommend a change in the S2, which should go a little bit higher. That's it. Yeah. $32,830. With the S3 remaining unchanged. Yeah, because it marks this low here. Okay. So, for the time being, we tend to maintain a bias for a sideways motion to be maintained between the R1 34,160 and the S1 33,500. There is a catch. And the catch is that the RSI indicator in the 4-hour chart was finally able to clearly break below the reading of 50. And I'm telling that because if you look at the movement, then we had practically continuous hits on the 50 reading and jumping back up while we have lower peaks So there is a downward motion here, which should not be neglected. And should the bearish sentiment intensify, that would be interesting. That may push or exercise downward pressure on Dow Jones, forcing it to break below the 33,500 and start paving the way slowly but steadily for the 32,830. For the time being, though, we tend to maintain a bias for a sideways motion, and for a switch to a bearish outlook, we would require not just the RSI indicator to be dropping, but also the price action of the indicator to break below the S1 33,500 of the index, sorry. For a bullish outlook, how remote that may seem, I would require a rise, a clear break of the 34,160, and the price action to start aiming for 34,920. Let's have a look also at NASDAQ. Okay, this is S&P 500 with a very similar picture. Note how the upward motion was interrupted. Right here. And the index has dropped below the 4,135, a level which practically was reversed to a support line, but now it's back to being a resistance line, given that the price action is above it, it's below it. Also here we have an RSI indicator dropping below 50, implying that the market sentiment is turning more bearish. We may see the price action of the US dollar index of the US 500, S&P 500 stabilizing. I wouldn't be surprised to see bearish tendencies here today. It's going to be an interesting American Open today, a very interesting one. Let's have a look also at NASDAQ. NASDAQ, in contrast to other US stock market indexes, remains in a clear-cut sideways motion between the R1 13,145 and the S1 12,850. It's characteristic how the index aimed, almost tested the R1 before correcting lower. Also note that we have a narrowing of the Bollinger Bands, but in this case as well, the market sentiment seems to be turning towards the bearish side as the RSI indicator is dropping below the reading of 50. It's nothing conclusive yet, it's actually only at 1481, but it's an indication where it's heading. Nevertheless, for a switch from a sideways motion between the R1 and the S1, we would require a clear break of the S1 12,850 in the price action to start aiming for 12,520. On the other hand, a bullish outlook could occur should the price action rise, break the R1 13,145, and start aiming for 13,400. Let's have a look also at WTI. Okay. We have a number of issues here. Okay, the first resistance line seems to be valid still, given the touches here, extensive touches here, and some resistance here. Let's readjust it. But there is a downward motion which cannot be neglected here. And I think that becomes more obvious if we drill to the daily chart. Give me a sec. Yeah. You have 1, 2, 3, 4 days of consecutive drops. On the other hand, though, we have to note here that in the 4-hour chart, the resistance lines have to be narrowed. I would be noting this true here. Yeah, test it again. Also, this true. Could go a little bit lower. And finally, this true. With consecutive touches. This level could go even here. We have a nice peak here. Okay, let's correct the labels. The R3 remains at 92.70. The R2 at 86.75. The R1 at 80.90. The S1 is being placed now at 76.20, sorry. Pushing it in. The S2 at 71.65. Yep. And S3 at 65.85. It's a clear-cut downward motion, in my opinion, which deserves traders' attention. And should it be extended, I wouldn't be surprised to see it breaking below the 76.20 support line and start aiming for the 71.65. But that's something which would possibly require some days, a couple of days. That should sum it up from all of us here at IronFX. Best wishes for solid trading.
Okay, just a disclaimer. The information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. Okay. So this material is just a personal opinion of the authors and the client's investments objectives, and risk tolerance have not been considered. Okay. IronFX is not responsible for any loss arising from any information contained. So redistribution of the material is strictly prohibited. Okay, I think I might have a setting that I need to change. Okay, wait. Okay, give me a moment. Setting up. Okay, let me continue. Kindly increase your volume. Yes, please increase the volume. I think I'm speaking at the max as loudest as I can already. So let us begin. So I'm actually from Everest Fortune Group, and my name is Chen Yongjing, and I'm the trade analyst for the company. We are the finalists for the best Forex research for 2019. 2020 and 2021. We are also the finalists for the Best Equity Research for 2020 and 2021. So right now we actually have a special collaboration with IronFX, where we are bringing you guys the good stuff. So IronFX right now, you can actually go to ironfx.com. For those who do not know, you can go to the website. If I'm not wrong, IronFX School, under webinars, listed as popular. You can see the, let it load first. Okay, you can see the, okay, I'm not sure why my face is not up here yet. All right, it's okay. So you can actually see the upcoming webinars. Wait, let me find the, okay, over here. We have the timetable for the upcoming webinars that you guys can actually attend. So right now is this webinar is live. So feel free to check this link out. So by the way, I know some of you guys want to contact me outside of this webinar. So feel free to check out my link tree. So this is actually a quick guide about myself. You can actually check out my Instagram, my YouTube, my LinkedIn profile. Feel free to follow me. All right, let us begin. So today will be a shared webinar. It will be with myself, Yongqing, and Sarah. So at the second half of this webinar, Sarah will be taking over. Okay, let us continue. So a few topics to cover today. So we'll be covering on, let me pull this chat around. We'll be covering on basics of news trading, key news events to watch out for, how each news event affects the markets, and 3 types of news trading strategy. So today will be a very, very dry lesson. So be prepared, get your coffee. I won't be showing much technicals. Today is all about the news, all about fundamentals. It might be boring, but it will help you a lot in a basic understanding of how news events actually affect the market, how you can bank on it to, scalp or either take a long position. So coming up first, 4 main factors to consider. Firstly, it's crucial. Okay, you can see a few points here, news events to pay attention to, what news events you want to pay attention to, and the expected data. So you want to also check the price reaction from previous news release. So firstly, it's very crucial to keep track of news events. I'm reading these points. And expected data releases. Economic indicators such as GDP, let me write this down, GDP, unemployment rates, inflation, can significantly impact currency values. Therefore, keeping an eye on the economic calendar and being aware of upcoming news releases can give traders like you guys an edge in predicting the market movements. So secondly, the price reaction from previous news releases is also an essential factor to consider. Traders can analyze how the market reacted to previous data releases and use this information to make educated guesses about how the markets will respond to future releases. So doing so, what you can do is you can go to Forex Factory. Let me show it to you. Can head on to Forex Factory. I'll send the link to the chat, so it's under calendar. Feel free to check out this link. Forex Factory, head on to Forex Factory. You start to look at all the news events. For example, tonight we have the United States dollar, core retail sales month-on-month, Empire State Manufacturing Index, retail sales month-on-month. So you do not know what does it do, how does it affect the markets. So what you can do, you can read a quick summary, click on it, read how it usually affects what you can have a summary change in total value of sales at the retail level, excluding automobiles. Can read more details about it. Go back to the forecast. So I think the more important one is core retail sales. So you can go back to the previous data release, which is on September 15, 2022. Go to your chart, click on it, start to go back and see how the news event actually impacted the United States dollar. So go head on to your DXY chart. Negative 0.3% versus previous 0%. So September 15, we can take a look at it. Let me load out my layout. Okay, so we'll be going through on core retail sales month on month on the DXY chart. Okay, DXY. So let's go back on the daily chart. September 15. September 15, right here. So notice upon the news release, price actually caused price to continue moving up in the long run. So you can actually start to look at maybe the 4 hours or 1 hour chart, want to see what happened on September 15. So September 15 around at night, price actually shot up before heading back down. You can start to check a reaction, what it does. Hits up first, clears the previous high. So every different news release is very, very different from each other. So find out the characteristics. First, it went up, create the previous high, went back down, tapped into some kind of support. So you back test it and back test this. I'm just giving you a very, very basic example. So you start to move on. I wouldn't be showing everything. So you'll be moving on to October 14, 16, December 15, January 18. Start to look at all this data, how it affected, how price moved. Get into accounts. Please do not just jump right in and try to trade the news event tonight just because you did some quick back tests on core retail sales and Empire State Manufacturing Index. So moving on back to the charts. Okay, back to the PowerPoint. So current trend, why is it very important? Okay, current trends in the markets are another crucial aspect of Forex trading. Traders can use technical analysis tools to identify trends, such as moving averages or trend lines. It's essential to know whether the market is trending upwards, downwards, or sideways, as this will influence trading decisions and risk management strategies. So last but not least, support and resistance levels is still very, very important in Forex trading. Important to consider. So these levels actually represent price points at which the market has historically shown support or resistance. Traders can use this information to determine where to set stop loss. So you can use it as a gauge stop loss and where to put your take profit level. Okay, moving on next towards the news events and expected data. So we actually have a very nice, clear screenshot of Forex Factory. So as Forex traders, it's very essential. Okay, before I continue, so we are actually focusing on the AUD. So right here, this specific news event is what we are focusing on. So as Forex traders, it's very essential to place close attention to the economic calendar and be aware of any upcoming news events and expected data releases. Firstly, these events can cause significant market volatility, which can lead to increased trading opportunities. For example, if a news event indicates that a country's economy is improving, traders might buy that country's currency expecting it to strengthen. So as a result, the value of that currency might increase, creating a trading opportunity. Okay, secondly, moving on to the expected data part. News events and expected data releases can provide valuable insights into the health of an economy. So these indicators can help traders understand how a country's economy is performing and whether it is growing or contracting. Traders can use this information to make informed trading decisions, such as deciding whether to buy or sell a particular currency. So third points that we want to go through. News events and expected data release can influence central bank decisions on interest rates. So we have the Bank of England, the Reserve Bank of Australia, etc. So can influence central bank decisions on interest rates, which in turn can affect currency values. So central banks actually use interest rates to control inflation and stimulate or slow down economic growth. So if a central bank announces a change in interest rates, it can impact the currency value and create trading opportunities. So last but not least, news. So just to summarize overall what I've just talked about this entire slide. In summary, news events and expected data releases actually help traders to manage risk by providing insights into the potential impacts of specific events on currency values. So for example, if there is an expected data release that could significantly impact a currency, traders might choose to exit a trade before the release to avoid the potential volatility. So this is why I do not trade 1 hour, about 1 to 2 hours before the news release, or 1 to 2 hours after the news release. So personally, I avoid that just to prevent any mishaps in my trading accounts. I do not want my trade to potentially cause slippage, potentially hit my stop loss, just because I wanted to be greedy and try to trade the news. So we are looking at the Aussie dollar, Australian dollar right here. So we had a cash rate. So they actually increased the interest rates. So previous was 1.35%, the forecast 1.85%, and the actual was also 1.85%. So what happened? Let's take a look how the news impacted the Australian dollar. So Australian dollar chart. So every time Australian dollar had a 50 BPS hike on the 7th June, price went down. 5th July, 50 BPS hike, price went down. 2nd August, BPS hike, price went down. 6th September, 50 BPS hike, price went down before going back up and continued going down. So we already know we have a data set, we have proven data on the charts. Data do not lie. So every time we have a news release like this, we can expect to possibly sell Australian dollar, AUD, USD, every time we have a cash rate news event coming up. So please screenshot this down before I continue. So I've already helped you done most of your homework, maybe for this specific news event. Please screenshot this down before we continue. Okay, moving on next. So I'm just zooming in on the 5th July. I'm zooming in on this right now, on this specific day that actually happened. So I cannot remember specifically because I actually did quite a number of research. So zooming in on the 5th July, 50 BPS hike, price went up, cleared the previous high right there before it, moved down all the way down towards the previous swing low, and it actually formed a support right there. So you already know price goes up first before heading down. So please screenshot this down before we continue. This is still related to the previous slide that I just showed you guys. Okay, next. The second August 50 BPS hike. You notice that price also went up first respectively right there. On a smaller time frame, it then, after the news release, immediately went down towards the previous support level. So every time we can expect price to likely head up first before the news release, before potentially just continue heading down towards the next key support level. Okay, moving on next to the key news events to watch out for. So we actually this is quite a long slide that I have to go through. So there's a theme of economic focus on what happened in the past, how it affected the markets, all the fundamental drivers that affected. First of all, going through the global financial crisis. It happened during the 2008 to 2009. Then the economic focus was a lot on employment data and wage growth. So for those who do not know, the global financial crisis is also known as the Great Recession. So it had far-reaching consequences for economies and individuals worldwide. It was triggered by a combination of factors, including subprime mortgage lending, a housing market bubble, and excessive risk-taking by financial institutions. So the crisis actually resulted in widespread job losses and had a severe impact on the employment market. So the unemployment rate in the United States, for example, it rose from 5% in 2007 to a peak of 10% in 2009. So many companies struggled to stay afloat, and as a result, many workers lost their jobs. Additionally, the crisis had a knock-on effect on other economies, leading to job losses worldwide. The crisis also had a significant impact on wage growth. As unemployment rates rose, employers had less incentive to offer pay rises or bonuses, and some even cut wages. So in the US, wage growth slowed from 4.4% in 2006 to 1.8% in 2009. So let me draw it. 4.4% in 2006 to 1.8% in 2009. So it made it difficult for many individuals and families to make ends meet. Okay, let me write this down. Unemployment data, 5%. 2007, it moved to a peak of 10% in 2009. So the global financial crisis had a domino effect on the world's financial markets as the interconnectedness of the global financial system became evident. Financial institutions that had invested heavily in mortgage-backed securities and other high-risk assets faced significant losses. And many banks and other financial institutions went bankrupt or required government bailouts. The crisis also prompted significant government intervention. Central banks around the world cut interest rates, and governments introduced stimulus packages to try to prop up their economies. However, it actually took several years for the global economy to recover fully from the crisis, and many countries are still feeling its effects. So overall, the global financial crisis was a watershed moment in the world economy, with far-reaching consequences for individuals and economies worldwide. The crisis had a very severe impact on employment and wage growth, leading to a significant job losses and slower wage growth. So the financial markets and central banks all had to take unprecedented measures to address the crisis, and its effects are still being felt today. Next, we have the COVID pandemic. I guess we just got out of it. So now is the post-COVID. So COVID happened 2020 to 2021. All of us went through it. The pandemic had far-reaching consequences for individuals, economies, and societies worldwide, and its effects will be felt for years to come. So one of the most significant impacts of the COVID-19 pandemic was on the gross domestic product, the GDP. So which is actually a measure of a country's economic activity. The pandemic led to a massive decline in economic activity as many businesses were forced to close or operate at reduced capacity due to lockdowns and restrictions. So the International Monetary Fund, the IMF, estimated that the global economy contracted by 3.3% in 2020, the most significant downturn since the Great Depression. So the pandemic also had a significant impact on employment. Many people actually lost their jobs due to business closures or reduced hours. The unemployment rates increased in many countries, and the number of people working part-time or on a reduced pay also rose. So as a result, many individuals and families experienced financial hardship, making it difficult for them to meet ends meet. The pandemic had very, very significant consequences for healthcare systems, with hospitals, healthcare workers overwhelmed by the sheer number of COVID-19 cases. Governments around the world had to invest heavily in healthcare infrastructure, including building new hospitals and acquiring medical equipment, such as ventilators and personal protective equipment, PPE. So moreover, the pandemic had a profound impact on global supply chains, with disruptions affecting industries such as manufacturing, agriculture, and logistics. Travel restrictions and border closures also led to a decline in global trade, affecting economies worldwide. So overall, governments and central banks around the world responded to the pandemic by implementing fiscal and monetary policies to support their economies. Many countries introduced economic stimulus packages, and central banks lowered interest rates to encourage borrowing and spending. So right now we have the 2023 recession that is coming up. So we'll be focusing on inflation data and interest rates. So this recession was triggered by several factors, including inflation, rising interest rates, and the COVID-19 pandemic. So inflation was one of the most significant factors contributing to the recession. So in many countries, inflation rates reached historic highs due to supply chain disruptions, labor shortages, and rising commodity prices. Commodity is wheat, corn, rice. So high inflation led to increased costs for businesses and consumers, causing a decline in purchasing power and economic activity. Interest rates were also a contributing factor to the recession. Central banks have raised interest rates in response to the rising inflation, which made borrowing more expensive for businesses and individuals. So higher interest rates also led to a decline in consumer and business spending, reducing economic activity. Okay. Give me a moment, let me get a cup of water. Okay, the COVID-19 pandemic also had an impact on the recession. The emergence of new COVID-19 variants and the resulting restrictions led to reduced economic activity and job losses. Many businesses, particularly in the hospitality and tourism industries, were forced to close or operate at reduced capacity, resulting in a decline in economic output. So the recession is leading to a significant increase in unemployment rates in many countries, and many individuals and families experience financial hardship. So governments are responding to the recession by introducing stimulus packages and implementing monetary policies to support their economies. Central banks around the world lowered interest rates and introduced quantitative easing measures to support the economy. Governments also introduced fiscal stimulus packages to support businesses and individuals. So these policies actually help to stimulate economic activity and support job growth. So this is just for general information about what has happened in the past 15 years or so. Okay, let me see what's next. Okay, non-farm and employment change. So this is a very, very important thing. It actually occurs on the first Friday of the month. Okay, one of the most closely watched, okay, just these 3 points, screenshot it down. It's related to the change in number of employed people during the previous month, job excluding the farming industry. So this is only for the United States only. Only US, it's not anywhere else in the world. So job creation is an important leading indicator of consumer spending, which accounts for a majority of overall economic activity. So it's also a high price volatility event. So NFP, also known as non-farm payroll, is a key indicator of the health of the US economy and is closely monitored by traders, investors, and policy makers. So NFP measures the number of new jobs created in the United States, excluding the agricultural sector. The report is released by the US Bureau of Labor Statistics on the first Friday of every month and provides insights into the strength of the US labor market. So the NFP report provides 2 pieces of information: the number of new jobs created in the previous month and the unemployment rate. The number of new jobs created is a crucial indicator of economic activity, as job growth typically leads to increased consumer spending and overall economic growth. The unemployment rates, on the other hand, provides a measure of the health of the labor market and can influence central bank policy on interest rates. So the NFP report is considered a leading indicator of economic growth and is closely monitored by traders and investors. A better than expected NFP report typically leads to a rise in the US dollar's value, as investors anticipate increased economic growth and the possibility of higher interest rates. So a worse than expected NFP report, on the other hand, can lead to a decline in the US dollar's value. So as investors become less optimistic about economic growth and the possibility of interest rate increases. The NFP is also closely monitored by policymakers, including the Federal Reserve. The Fed uses the NFP report to determine whether to raise or lower interest rates. So with higher employment rates, it actually leads to higher interest rates. Okay, please screenshot this down before we continue. Okay, next. Moving on towards interest rate decisions. So central banks hike interest rates to increase the cost of borrowing. It slows down economic activity. These are the main important points only. Please screenshot it down. It reduces or slows down the speed of inflation and is also a high price volatility event. So Interest rates are a crucial tool that central banks use to manage inflation, economic growth, and financial stability. Interest rate decisions can have a significant impact on currency exchange rates, stock and bond markets, and individual financial planning. So interest rate decisions are made by central banks, which are tasked with maintaining price stability and supporting economic growth. Central banks can adjust interest rates up or down depending on economic conditions and their policy objectives. A rise in interest rates can reduce consumer spending, lower inflation, and support a currency's value. A cut in interest rates can stimulate borrowing and spending, support economic growth, and weaken a currency's value. So interest rates are typically announced after a meeting of the central bank's monetary policy committee. The announcement includes a statement that outlines the central bank's reasoning behind the decision and any future policy changes. The statement can provide insights into the central bank's outlook on the economy, which can influence financial market expectations and individual investment decisions. So it can have a significant impact on financial markets. A rise in interest rates can lead to a decline in the stock markets as companies' borrowing costs increase and consumers may reduce their spending. So higher interest rates can also lead to a strengthening of the domestic currency, making exports less competitive. A cut in interest rates, on the other hand, can lead to a rise in the stock markets as companies' borrowing costs decrease and consumers may increase their spending. Lower interest rates can also lead to a weakening of the domestic currency, making exports more competitive. Okay, let's move on. So the inflation data, the CPI. So the consumer price index, so it actually measures the change in price level, indicates the change in the cost of living, and the target CPI for the economy is 2 to 3%. So please note this down. This is very, very important. Please screenshot this down. So the CPI measures the average change in prices paid by consumers for a basket of goods and services over time. So it's a crucial indicator of the health of an economy and is closely monitored by policymakers, investors, and consumers. So inflation is the rate at which the prices of goods and services increase over time. A high rates of inflation can lead to a reduction in the purchasing power of money, making it more expensive to buy goods and services. On the other hand, low inflation can lead to deflation, which can harm economic growth and create disincentives for businesses to invest. So the CPI is used to measure inflation and is one of the most commonly used indices. The CPI calculates the average price of goods and services, including food, housing, energy, healthcare, and transportation. Mind my writing. It's a bit hard to write using the pen. So changes in the CPI can over time provide insight into the rate of inflation. So the CPI is released on a monthly basis, closely monitored by policymakers and investors, provides insights in the state of the economy, and can influence monetary policy decisions. Okay, so high inflation leads to a rise in interest rates, which can increase the cost of borrowing and slow down economic growth. Low inflation can lead to a lower interest rate, which can make borrowing more affordable and stimulate economic growth. So inflation data also has an impact on individual consumers. A high rate of inflation can lead to increased costs for everyday goods and services, which can reduce consumers' purchasing power. Low inflation can lead to lower costs for consumers, making it more affordable to buy goods and services. Okay, let's move on. Right now, Sarah will be taking over. So yeah, let's welcome Sarah. I'll be taking my leave.
Hi everyone, my name is Sarah. Okay, so today I'm going to take at the second section of this webinar. So just now Yunjin has mentioned it. Okay, so for the Kiwi dollar, the CPI news is really important. So now let's take a look at the next slides. It's about how the give me a moment. Let's take a look at this slides is how the news is affecting our price and how the price is reacting towards the news. Okay, you can see before the news come. Sorry, where is my mouse? Okay, here. Can you see my mouse? Okay, so you can see before the news come, there is a very nice steadily ascending trend line. So the price is going to react it according to the trend line. Okay, and you can see before the news come, the price is more in a consolidation, means the price isn't moving very much. Okay, so it's more like up and down, but in a more horizontal way. But you see at the 6 p.m., the news have come out. Okay, so the news will affect the price of the market. That's why the price has shooted up. Okay, shooted until where? Shooted until the period swing high. So always take note when we are reacting towards the news, always looking for a reference point. Don't always say that, oh, the price may go up to here or the price may go up to here. Okay, you need to find a reference point, which is very important. Most likely the reference point is the period swing high or the period swing low. Depends on how you judge the news going to affect the market. Okay, next one. Okay, so you can see here are all the news. Here are all the news of the. Here are all the news of it's very important news on the 13th October. So always. Okay, so always remember the news event you need to pay attention and the expected data. Always pay attention on the current trend, okay? And always pay attention on support and resistance lines. So their price is going to reaction after from the previous news release, okay? So you need to take it as a reference. Okay, so here you can see there is a news coming up. I think it's at before the price is consolidation. So you can see the price didn't move a lot. After the news release, the price has shooted up and now retreats back. So how each news event affects the market? So for short-term effect, okay, so there are some news will affect it in a more short-term term. So for example, employment change, retail sales, and purchasing manager index. So later at 9:30 p.m., there are retail sales for USD. So maybe later we can pay attention to it and we see how the news is going to affect the market price. So employee change is a very key indicator of economic health and have short-term effect on our trading. A strong employment change report can indicate a growing economy, and increase customer confidence, leading to a stronger currency. In another scenario, okay, a weaker employee change report can indicate a weaker economy, leading to a weaker currency. So most likely the employment change is correlated to the currency. So if employment change is good, okay, so the currency is going up. If otherwise, it will go down. So how about for retail sales? Retail sales are another economy indicator indicate that short-term impact on the trading. So retail sales measure the total amount of goods and services sold by retailer. And a strong retail sales report can indicate increased customer confidence and spending. This can lead a stronger currency as the investor become more optimistic about the economy. A weaker retail sales report, on the other hand, can lead to a weaker currency as the investor become less optimistic about the currency. So this one same as employment change, okay? Retail sales good, currency go up. Retail sales bad, currency go down. So lastly, the PMI. Okay, so PMI is a survey of purchasing manager in manufacturing sector that measure the level of business activity. The PMI can have a short-term effect on forex trading. It provide the insight into the strength of the manufacturing sector and the overall economy. A high PMI indicated increased manufacturer activity and growing economy, leading to a stronger currency. So in alternate scenario, a low PMI will indicate a weaker economy, leading to a weaker currency. So all three of these are very correlated to the whether the strong or weak is the currency. So the better the number is, the better the currency. The weaker the bad the number is, the weaker the currency is. So bear in mind, so this three factor is only going to affect the currency in a short term, which means after the most likely after the news has been released, within like a few hours, or like within a short term, the price will be changed according to the news, but it's unlikely to going to affect the currency in long term. So now let's take a look at what will affect the currency in a medium to long term. What are the factors? So first one, very straightforward, is GDP. And another one, secondly, is the CIP. And lastly, the interest rate decision. So let's take a look at GDP, okay? GDP is a measure of country economic output and is considered one of the most important economic factor. GDP measures the total value of goods and services provided within a country border and provided insight into overall health of the economy. A high GDP can indicate a growing economy, which means a stronger currency. A low GDP indicates a weaker GDP and lead to a weaker currency. So imagine the news has released like United States, the GDP has went up, which means the price of the currency will go up. So secondly, let's talking about inflation data. Inflation data as measured by Customer Price Index, CPI. So it's another key economic indicator that can impact forex trading over medium to long term. A high rate of inflation can reduce the purchasing power of the currency, leading to a weaker currency. In other hand, low inflation can lead to stronger currency, which indicates a stable and growing economy. So lastly, our interest rate decision. Interest rate decision are also important indicator for our trading. So central bank use interest rate to manage inflation and support economic growth. A rise in interest rate can lead to a stronger currency. As the investor may be attracted to a high interest rate, most they want to deposit in that interest rate, or because it's high interest rate, I can deposit over and to gain more interest. So in alternate scenario, a low interest rate means less demand of the money, which means the currency may be dropped. So this three factor, or this three related news about this three factor, is going to affect our currency in a more medium to long term effect. So imagine that this kind of news has been released, okay? Maybe the price may not move like a lot, but in the future or in a more mid to long term, the price is going to react to these factors. Now let's take a look at news trading strategy. Means how are we going to enter in a trade by the news, or like according to the news. So there are three different kind of trading strategy. Firstly, entering before the trade release. So most likely we are looking at 1 hour or 15-minute chart. So what meaning by entering before the release means we are predict on the numbers. Imagine like later the retail or the US retail news going to release. Okay, so let's just make a prediction whether the news is good or not than compared to the previous one. Okay, so if you are considering, okay, I have confidence in this, okay, the news is going to be good, means better than before. So this, you may enter in the trade in a long position, which means I think, okay, USD will go up. So the goal is to catch the maximum move following the news release. Because you are entering the trade, most likely you are putting a buy or sell limit before the news release. So the strategy can be very dangerous, as the trader can take advantage of significant price movement. However, there is a risk of being backed off, as the market can react unpredictable to the news release, which means maybe the news may be good, okay, but the market did not respond in after the news come. So maybe the news good, but the price still dropping down. So maybe it will hit your stop loss. Then finally, the market has reacted to the news. There may be a chance in this kind of scenario. So how about our second strategy? Our second strategy is using pending order. This involves placing an order ahead of news release. Okay, so it's more likely using a 1 hour chart. The strategy has less emotional involvement. Okay, so as the traders set their orders and wait to the market to fill them. However, there is a risk of price spillage, as the market can move significantly after the news release, causing the order to be filled at a different price than expected. So our third strategy is to reacting to the news release. So means after the news release, we are reacting, we entering the trade according to the news. Most likely we are using 15-minute or 1-minute chart. So this involves the trading you used it on 15-minute and 1-minute chart. Trader wait for the news to release or to come out, then they react based on the price movement. This strategy can be beneficial, as the trader can react to what they are seeing in the market. However, there is a risk of being influenced by price movement and making irrational trading decisions. So each strategy has its own set of good advantage and disadvantage. So when we are entering the trade, think carefully to see which one is best fit your trading strategy. And also always remember, manage your risk. Trader must be prepared to accept the loss and have a solid risk management strategy in place before you enter in any trade. Okay, so that's all of today's webinar. Is there any more questions? So by the way, later at 9:30 p.m., there is a very important news on USD. So maybe you guys can pay attention on it. How would you feel the USD going to react? Okay, so if no more questions, I may just end today's webinar. Thank you, Edrica Das. Thank you, Iram Atadi. Thank you, Mogizi Likope. And thank you, Steve Code. Okay, forgive me if I pronounce your name wrongly, but really thank you for you guys attending this webinar. Okay, that's all of today's webinar. Thank you. Bye.